Today I've been asked to provide an update on the Active Growth Fund and answer a few commonly asked questions. Well, firstly and foremostly, we've reduced our allocations towards shares. So typically as a growth fund focused on long-term investing, we have around 80% invested in shares. When we became concerned about the coronavirus and its spread out of China and across the globe, we reduced that allocation to shares to below 60%. Secondly, we changed the type of shares that we're invested in. So we were avoiding shares that are going to be directly impacted to the coronavirus, such as the tourism and travel sectors, and those shares in highly levered companies, and those companies that have got high degree of operating leverage, such as the retirement sector in New Zealand and banks in Australia. Well, firstly, we focused on companies that are beneficiaries of the coronavirus. So in New Zealand, that's A2 Milk and Fisher & Paykel Healthcare. In the US, we invested into video game makers EA Sports and Activision, Blizzard. Both of those companies we thought would benefit as people are locked in their homes and are looking for cheap forms of entertainment. And in Australia, we invested in the supermarket company Coles. Obviously, with everyone locked down and supermarkets still open, the sales of Coles we think would rise. We've been debating amongst the team, is that rise going to be permanent? And we think there will be an element of that as people continue to eat at home. Well, as we've moved through the virus and people have started to factor that into share prices, we've actually started to look at some of the companies that are being impacted by the coronavirus and that have been oversold. So we were able to participate in the discounted capital raisings of companies who acted to shore up their balance sheets. And two examples of those are Flight Centre in Australia and Kathmandu in New Zealand. So Flight Centre obviously impacted by almost having zero revenues with the travel sector closing down, and Kathmandu being a retailer again having no sales but continuing to have expenses. So the first part of our analysis focused really on, are they raising enough capital or enough money to be able to get through an extended period of lockdown? And in both cases we got comfortable with that. And then the second question we asked ourselves was, well, what's the business going to be like post-lockdown? Are earnings going to be continue to be impaired? And in both cases, yes, we thought earnings would be lower than the future, but we became comfortable that even assuming a lower level of earnings, around about 80%, these companies were still very attractively valued. In the case of Kathmandu, we forecast that in a couple of years' time it could be trading on 5 times earnings, and that's less than half what it typically trades at. So both of those companies have performed well since they came out of capital raising, both up over 60%. So that's the sort of some of the companies we're focusing at the moment, moving away from the pure beneficiaries, but those companies, and looking at those companies that have been potentially oversold and on a medium-term point of view have got attractive business models. So we're looking at 3 main areas. The first is the course of the virus, and that continues to be highly uncertain, but we continue to listen to independent expert calls, which really say that the virus is going to be difficult to contain, particularly in overseas countries where it has got, in some cases, out of control. Secondly, we're focused on the economic impact of the virus. So we know that the economic impact is severe at the moment. However, that is being offset by really strong moves by central banks and governments around the world to help cushion the economic environment. But we know that some sectors are going to be impacted. And the real estimates we're trying to make is how long the virus is going to last and what other moves enough by central banks to help cushion those impacts. But we do know that some sectors are going to be impacted. And the third thing that we continue to look at is, what are markets pricing in and what do we think and where are the opportunities? So a lot of the team is really focused on getting out there, looking at the companies, talking to companies, trying to figure out what the earnings are going to do and trying to isolate attractive opportunities on a medium-term point of view. So all in all, though, we remain cautious because of the degree of uncertainty in markets, and following the recent bounce, in a lot of cases we don't think we're getting rewarded for taking too much risk, but we still are finding attractive opportunities And actually, this is a pretty exciting time for us, just given the degree of opportunities out there in the market and the huge movement. So yeah, we are excited. There's a lot of work to be done and a lot of things to cover, but we are excited about potential opportunities. So that's all for me. Thank you for listening.